how we make the investment decisions. So as you know, you might be aware of the NPV rule and the IRR and payback period and everything else, right? So in this chapter, in this course, we are going to look at those rules again. If you already are aware, that's good. You will be able to capture it faster. If you are not aware, then you will be able to gain the understanding. So the first thing is the net present value. So net present value, basically in the past slides we learned how to calculate the present values, right? We say that if you are getting money for the next year, the money is not the same value as today, so you need to calculate a present value based on certain rates. At the moment we use the interest rates, and for this module we will assume the interest rates is given, and then after this we will learn how we establish those rates as well. Okay, so net present value is the most commonly used method of investment analysis and decision making. It means that they will calculate present value of all the future cash flows and compare with the cash outflows of this year, this present, and then they will calculate how much is the net amount. If the net amount is higher, I mean it's a more than zero, then it means they will gain by doing this, and if it's negative, it means they will not be able to gain. So the formula to calculate net present value is present value of the benefits minus present value of all the cost. So you will calculate, since in most of the examples we will assume cost as today, but it's not necessary, right? If let's say you are building a office or building a factory, it may take 2 years or 3 years or 4 years to complete. So in that case, the cost is not all the money that you are paying, is the present value of the cost. So we will factor in all the cost that we are paying in future, in second year, third year, fourth year to this year, i.e. the present time, though we will factor that also. And then we will also calculate the present value of all the benefits that in the future we will be accruing from this building. Maybe we are saving rental, or we are going to save on telephone or electricity or whatever, right? So that's the NPV rule. So a very simple example of the net present value is that if you exchange $500 today, your firm will get 550 in the 1 year. If your interest rate is 8%, so the way to calculate is PV of benefits, i.e. the 550 at the rate of 1.0 watt, which is $509, and the present value of the cost today is 500. So the net present value will be $9.26 today. Now the net decision rule, so it means that you should be able to borrow, or the other way to look at it is you should be able to borrow $509 today and use that money to pay 550 in the future, and you spend $500 today, so you keep $9.26 today, you save it immediately already, right? So that is the net present value. So the decision rule for net present value is that if it's a standalone project means this project is not dependent on any other project. Then if NPV is more than 0, you will accept the project. If NPV is less than 0, you will reject the project. So means if the present value of benefits is lower than the present value of cost, you will reject the project, you will not do it, right? But if it's a mutually exclusive project, means it's a decision between A or B. So you have to choose different the project, either you do this or you do that, right? So in that case, you will choose the project where the NPV is higher. So it's not a standalone project, means even if you accept or you don't accept this project, the other project has no decision. If you have to select between two different projects, then you will select the project which is higher in net present value, right? But the problem is, in the major shortcoming of this NPV is that you cannot decide on the different size of projects. So let's say one project will require an investment of $200,000, another project may require an investment of $500,000. So even though the NPV of $500,000 will be higher, but your initial investment as of today is also much higher, right? So it means that you cannot simply compare the two projects like that only based on the NPV. But we have a workaround of this major shortcoming, which we'll be learning in the future slides. Okay, so how do we use the NPV rule? We will organize the cash flow first, computing the net present value, or take it or leave it decision. So here is an example. Now you need to calculate the NPV for it. So in this example, the fertilizer company is creating an environmental friendly fertilizer, and it will require them to build a new factory. The cost of building it is about $81.6 million, and the estimated return of this fertilizer is $28 million after first year until 4 years, right? So you will have 4 cash inflows of $28 million and with a cash outflow of $81 million today. So here is the timeline. So $81 million today out, and plus $28 million every year for the next 4 years. So if the interest rate is, let's say, 8%, how much would be the net present value? So you can calculate that now based on this particular formula. So if the interest rate is, let's say, 10%, can you calculate a net present value now? If this project, we calculate the NPV at different rates, let's say we calculate at 0% and we calculate at 24%. So we calculate every time. So NPV is coming at different time, different values, right? There is something called NPV profile, which is normally not used in practical sense, but is a theoretical part to understand one very critical aspect. And when we calculate the NPV at different rates, we get the different NPVs, right? And we plot them on a graph chart. So here is at 0 at 30%, to 4 at this percent, and 14 at 0, and then different. So here you will see the NPV is going 0 after 14%. So this 14% is called IRR, or you can call it an internal rate of return, at which the project will give none, will give 0 NPV, means 0 NPV, no profit, no loss. That is called the internal rate of return. So the internal rate of return you can compare with your cost of capital, which is 10%. At 10% is 7.42%, right? And IRR is 14%. So there are two ways to look at this project now, the two perspectives. One perspective is we calculate the NPV at our cost of capital. If it's plus, we accept the project. The other perspective is we calculate the internal rate of return when the NPV value is 0, which is 14%, and we compare that IRR with our cost of capital. So if IRR is more than our cost of capital, means we will accept the project. If IRR becomes less than our cost of capital, then we will not accept the project. So this is another way to look at it. And this NPV profile will also give us kind of sensitivity that how close we are to become negative in terms of NPV, because these assumptions, 28 million is just an assumption, right? We don't know these assumptions are correct or not correct. So there is a sensitivity, right? In order to calculate that sensitivity, we can see how many percent of change in the rate will lead us to negative. We will look at that later. We are going to calculate the sensitivity part at a later stage. But for this time, it's important to understand when our project is going to be negative and what is our IRR of internal rate of return for our project, right? So coming back to NPV, the net present value of this project is positive $7.2 million. We will accept the project and say, okay, we will execute, we go ahead with this. Many of the time in the real corporate life, this is how the decisions are made. Either of the two is used, either IRR or net present value. And just for your benefit, in case you calculate both, if there is a consistency, like IRR is giving something else and NPV is giving something else result, you will always follow the NPV. So NPV takes precedence over IRR. So if you are calculating both IRR and NPV for a project, in that case, and they are giving you the mixed results, which we will see in the later slides, then you will follow the NPV. Okay. So this is how you will use the NPV rule. The NPV rule depends on the cost of capital, and this is the NPV graph at different rates. So based on that, we will get the IRR, right? So now we can also measure the sensitivity with the IRR. If IRR is very close to the cost of capital, it's too sensitive, right? It's too risky that your project may not be correct, may not be a good solution because the gap is pretty low. right? As a good practice, you should compare your NPV, your cost of capital, with the IRR, because you are not 100% sure on what is your cost of capital. The cost of capital depends on your assumption at what rate you want to discount. For example, in Myanmar, if you are having a project, you will use maybe 20% for doing the discounting, but same project in Thailand, you will use 10% for discounting. If it's in China, you may use a different rate for discounting. So the cost of capital is prone to risk involved in the environment, and also the risk-free rate at which we are getting the project. So, and it's different for each company, right? Cost of capital is different for every company. It depends on their structure, how they are structured. So that's why it's good to calculate IRR and check what is your immediate borrowing cost or immediate cost of acquiring the additional capital, or your existing rate of return in the business, so that you can really compare if this is a worthwhile project or not. So there are alternative use of versus the alternative rules versus the NPV rules. So when you are evaluating the alternative rules for the project selection, then you may or may not give the same answer. So as I said, whenever there is a conflict, you need to base your decision on the NPV rule. So if you are using an NPV rule and a payback period and the IRR all together, and all of them give you a different answer, then you will prefer the selection based on the NPV rule. Okay, we will look at the other methods, and then we will look at the example, one example to calculate everything, so that you have a better understanding of all the three methods. So the second rule that we have is payback rule. So the payback rule basically is just a simple notion that there's an opportunity cost, that payback is the initial investment. Paying back the initial investment quickly is a good idea. So you normally calculate the amount it takes to repay your initial investment, and you will accept the project if it's within your pre-specified length and reject if it's more than that. So for example, in the high uncertainty areas, for example, if somebody new company is coming in and want to invest in Myanmar, for example, they say, okay, it's the certainty is only for 1 year. So if I get my money back within a year, I'm happy to invest the money. So that is their preconceived notion in terms of investment decision, even though it's not based on any scientific rule. So but it's their decision making process. So they will calculate the return on investment when how fast they are able to get, and then they will make a decision based on that. So for example, in this Frederick example, the one that we take, if we want to calculate the payback period, we will accumulate all the cash flows 28, 28, 28, 28, and see when it's equal to 81. It means the payback period for this project is somewhere about 3 years, right? 2.89 or something, right? Or maybe 2 years 11 months, or you can say like that. So that's the payback period of this. So if let's say Frederick decides, I want my investment back in 2 years, because there may be a new, if they think, let's say, that there can be another company who may want to, after they establish the plant, they may also establish the plant, and they also want to undercut their fertilizer, means they may be losing their edge over the competition, right? So they want to get back their money within 2 years. So in that case, this project is not worthwhile on their investment philosophy. But if they say, I'm okay, my fertilizer cannot be copied, I can go on for 4 years, then this project is good for them, because the money is coming back in 3 years. The only downside with this payback rule is you're not discounting the cash flows, right? Because you are taking the cash flows at face value. So usually there is a alternative method to it. There is a modified version of payback period, which is called discounted payback period. So if let's say you discount every cash flow which you have already discounted, 28 into 25, 23 into 22, 28 into 21, and 28 into 19. Now you recalculate your payback period. Can you recalculate your payback period based on discounted cash flows? So the payback period increased, but that will give you a bit of more reasonable nature, right? Reasonable estimate of what is the real payback period in terms of present values, right? So means 3.5 years to get the investment back. So that is one modification into the payback rule that is historically established. But there are other challenges in the payback period. And what are those challenges? Let's consider this example. So if you follow the payback period, you follow the project which is shorter in recovery. In that case, the project B should be selected, right? Because it's shorter in the project, right? But if you look at the other years, let's say look at the fourth year, if you consider the fourth year, then which one you will accept? Obviously project A, right? Because it's giving $1 million in the fourth year. So that is the one of the limitation of the payback period is it does not calculate, or it does not consider the cash flows outside the payback period. So if the payback period has 2 years or 3 years, it stops there. So it does not consider the cash flows of year 4 or year 5 or anything like that, right? And also it does not consider the size of the cash flows. So what is the size of the cash flows? What is the overall life of the project? So it does not care for those details. That's why payback period is highly subjective and emotional kind of decision. It's not scientific method. So the weakness of the payback period is it ignores the time value of money, which you can modify which you can overcome by discounting the cash flows. So not a problem. But it ignores the cash flows after the payback period as well. So that's again a limitation. And then you have a limitation on lack of decision criteria grounded in economics, because we are not considering the life of the project. So then cash flows over the entire life of project. Same like NPV, where we look at the life of the project and see what will be the future benefits until the end of the life of this project, and then we calculate the NPV, right? But in the payback period, we don't consider the future cash flow. That's the weakness in this payback period. Okay. Then the third method that we normally use is called IRR, internal rate of return. Even though I have explained you briefly, the IRR means this is the rate at which your present value of future cash flows is equal to the present value of your cost, of your today cost, right? So that is the IRR. So you will need, how you are going to calculate the IRR, because you don't know the rate, right? So in the Excel, you have a formula called equals IRR and select all the cash flows. You will be able to get the IRR. So after I give you this decision rule, then I can show you how we calculate in Excel, so that it's easier for you in the future. Otherwise, IRR calculation is time consuming. If it's a standalone project, we will accept the IRR if IRR is more than the cost of capital, or reject if IRR is less than the cost of capital. In case of mutually exclusive projects, we will accept the project which is higher on IRR. So it's similar to NPV. The difference between this and the NPV is that here we are talking about the internal rate at which the NPVs become 0. Right? And in NPV, we calculate actual realized value of the project. So that's why the NPV is a better solution. So the steps in calculating IRR is usually trial and error. So I give you the method first, and then we take over the Excel easily. So first step in calculating the IRR is you need to guess, make an estimate, maybe make a rough estimate. As a best practice, we normally use 10% as a standard, so that because 10% calculating present values at 10% is fairly easy, right? And then you calculate the project's net cash flow using this rate. If the net present value is 0, means you made a perfect guess, good on you. If your NPV are more than 0, then you need to increase the rate. So you need to guess a higher rate. And normally, if I follow my best practice, I do 10% fluctuation or 5%. So either I will guess directly 15 or 20, depending on how much is the NPV compared to the original investment, right? If NPV is less than 0, even at 10%, then I will try a lower interest rate. In that case, I will go back to 5 or maybe 2%, whatever, depending on what is the difference. So remember the NPV profile, right? It's the one way is to put it on the graph and then draw the line, but that may not be the right way. So the limitations of the IRR, the technical limitations of the IRR are that it sometimes gives multiple solutions, especially when there are more than one cash outflows. Normally, typically in the examples, you will see there is only one cash flow at the beginning of the year, and after that, it's only positive numbers, cash out inflow only, right? But in real life, it may happen that you may have a cash outflow in the beginning, then some cash inflows, and then some cash outflow again, and then some cash inflows, or maybe for first through 3 years, there is a cash outflow. So in that case, if there are multiple negative signs, there will be multiple IRR also. So there can be multiple solutions to IRR. So there are more than one IRR. There is another assumption that whatever we are earning from the project, we are reinvesting into the project at the same rate. So that is the assumption that IRR is making, but that may not be the true always, because we are not reinvesting all the money that we are earning from the project into the project itself, right? We may be using it somewhere else where we may not get the same rate of return. So in that case, the IRR is different. So that is the reason why we have this. So to solve this, there is a method called modified IRR, which I think we will have a discussion later on. The most popular decision rules that is used by CFOs around the world is the IRR and NPV. But NPV is the most preferred way of making decisions, even though IRR is always also calculated in the project. So you have both NPV and IRR for certain projects. The payback period is least used method in the three. Okay, so let's say if you calculate the original one from our example, summary of the decisions, let's say NPV at 10% is 7.2 million, we accept. Payback period is 3 years, but our required rate was 2 years, so we rejected. IRR is 14%, which is higher than our cost of capital, i.e. 10%, and so we accept the project. So in that case, normally since IRR and NPV is recommending the project, we will follow it through, right? Let's look at some examples before we go on to the next topic. So there is two competing endorsement that you have. Offer A is a single payment of $1 million upfront. Now you get $1 million, and offer B is $500,000 at the end of next 3 years. So which one you will choose? NPV for this project is actually minus 243,426. So in this case, NPV is option B is better because the minus is more. The present value of $500,000 in 3 years is higher than 10 million. So it means you should take the $500,000 in 3 years. There's a conflict. So we want to resolve the conflict by using the NPV profile. So you'll see the NPV profile of this option is that if we calculate the discount rate, cost of capital is 10%, at that minus 243,000, and the cost of capital is 23%, where the NPV is 0. If return is 25% and more, then only the option of getting $1 million now is going to be profitable, because in this case the negative options are first. If you reverse the signs, minus 1 million and plus 5 plus 5 plus 5, then the IRR will give you a different result. For me, IRR, I just calculate like this. I didn't calculate, it was calculated already, so it's 10 million, right? The other way to calculate the IRR is use the rate method, rate formula. So there are rate, NPER, i.e. period is 3 years, right? PMT is $500,000, correct? Present value is 1 million, and then you will get the same rate, same result. So you can use either of the formula, IRR simple and rate formula, so you will get the same result. But if let's say we reverse the sign, right? We say that it's minus 10 plus 5 plus 5 and plus 5, then also you will get the same result. In that case, the option is different now, right? Sometime whenever there is a conflict, we always use the NPV as a standard method of solving. Even if you see logically, $500,000 if you receive in 3 years, their present value is 1.24 millions, and if you accept $1 million now, you will lose $1.2 million, right? Obviously use the option B. And then there are multiple IRRs. So let's say if the cash flow is suggests, then the company say, okay, I will give you another 600,000 after 10 years. After 10 years, so it means you have a 0 in the 4th year, 5 years, 6 years, 7 year, 8 year, 9 years, and then 10th year you get another $600,000. So if you follow the IRR formula, your return is different, right? definitely return different, but there are multiple returns. So here you will get one IRR at 5% and one at 13%. So there are two different IRRs. So to solve this, we use the method of called modified internal rate of return. So the modified rate of return is to get rid of the multiple IRR problems. We normally modify the cash flows by two ways. One is we bring all the negative cash flows to present value and incorporate the initial cash outflow, leave the positive cash flows alone. Or we leave the initial cash flow alone and compound all the remaining cash flows to the final period of the project. So there are two options. In this case, normally if you calculate the IRR from different methods, you may get different rates. In the Excel, it will show only one, but if you calculate from the traditional method of having two different IRRs, two different calculations of NPV, you will get another IRR. So to solve this problem, to make it MIRR, normally there are two choices. So in this case, your IRR is 18% different. And another method to recalculate the modified internal rate of return is you calculate the future value of all these into this point, right, at the end of this. Let's say the initial investment of 1 million, you are making a profit of 500,000, 500,000, 500,000 in 3 years. But in the fourth year, you have to spend another $500,000 on the project, on doing something, right? And at the end, the final year, you get another cash inflow of 600,000. So you are now calculating an IRR based on this cash flow, which is coming to at 23.02%. Normally, when you have multiple negative signs in the cash flows, you will get multiple IRRs also, right? Because the one IRR is not going to be the same. So there will be multiple IRR. So to solve this, there is a method called modified IRR. So we recalculate the IRR based on readjustment of our cash flows. So what we do for that, there are two methods. One is we bring the negatives to the negatives, means all the negatives. So we will calculate the present value of this negative amount and we add to the original cash flow, assuming that this is the money that we are paying at the beginning of the year. And since the present value of this $500,000 is 341,000, so we will assume our initial cash outflow is 1.34 million, right? And the other cash outflows will remain same where they are. So $500,000, $500,000, $500,000, and since this is we have removed, so it will become 0 and this will become 600. So we will recalculate the IRR based on these modified numbers. So here the modified number is 18 million. Now, since there is only one sign in all the cash flow, only one negative sign and all the rest are positive, there will be only one IRR. There will be no other IRRs. And the other method or other way to do this is what the prescribed method is. We modify all the outflows to the future. So we will recalculate all the cash flows to the future value, which is we will bring this 500,000 to the future value of 6th year, means we will calculate the future value for 5 years, and here we will calculate the future value of 4 years. Here we will calculate the future value of 3 years, for 2 years and 1 year. So in this way, what we are doing is we are going to recalculate all the numbers here, and then we will put everything into final year, and then we recalculate the IRR again. So here is the different IRR. So there are two different methods. They both will give you a different answer, but these are the two possible choices for calculating one IRR only. So in this case, you will get one IRR. It's not going to be the same, and it's a bit of extra work to do, right? So the easier way is just calculate the NPV and be happy, right? So the next topic that we want to tackle here is choosing among the different projects. So if let's say there are multiple different type of projects and have different life and have different lengths, so the choosing is not that very easy, right? So there may be mutually exclusive projects, and so you just cannot pick the project with a positive NPV, right? Because then you have to rank the project and the best one is to be chosen, and you will pick the project with the highest NPV. So here is an example which we want to consider. So you just need to write down, you have a small piece of commercial land near a university and you want to do something with it. So you have a choice, either you sell it and you get $220,000 now, right? Or otherwise you can open a bar, a coffee shop and an apparel store. If you want to do that, what would you do if this is the information? So here is the initial investment in the coffee shop, in the apparel store. Cash flow in the first year is 60,000, 40,000 and 75,000. Growth rate is 3.5% and cost of capital is different. Now the cost of capital, as you will say, is different in different projects because of the inherent risk. We will cover that later on, but for the time just calculate the net present value. So if you do it right, you should get NPV of 305,000, coffee shop 370,000, apparel store 250,000. The comparison of all the investments is coffee shop you get 375, bar you get 305, apparel store you get 250, and if you sell the land you get 220,000. So you will make a choice because it's a one mutually exclusive project. You can accept only one of them. So you will choose the one which is the highest NPV, means coffee shop. So you will invest another 400. Now the question is, first you need to have 400,000 first, right? Then only you can $200,000 to open the coffee shop. Then only you can have the coffee shop and this cash inflows, right? Now let's calculate the projects on different scales. A 10% IRR can have a very different value implication if initial investment is 1 million or 100 millions, right? So let's say the identical scale. So let's say Maria, she invests in her boyfriend's business, which is $10,000 and give her a return of $6,000 each, right? Each month at the rate of 12%, her NPV is $4,000. And if you do her delivery business, just buy one drone, then she can earn minus 10,000 plus $5,000 in return. So she get $2,000. So if you calculate the IRR of her boyfriend's business is 36%, and IRR for the delivery business is about 24%, right? And the cost of capital is always 12%. But if let's say she's decide, okay, actually she can invest 10 drones in her delivery business and setup cost is $50,000, and then the annual cash flows will be $25,000. In that case, she will be able to make $10,000 worth of net profit and her IRR will be 23%. So IRR is not going to change because it's the same number, is just increase the things, but the only difference is that the NPV scale will be different, right? So there is a crossover at 20%, where the NPV of both the boyfriend business and her delivery business will be the same at 20%. If they are able to earn more than 20%, which is in that case they are earning 23%, so their IRR is going to be higher. Okay, so here we are going to discuss another project where we are with a different lives. So the projects are having a different life. So in this case, you have two projects. One is, you can see in the year one, it's, let me give you a background of this problem. So normally you buy a server, right? Servers or other softwares or other solutions where you have an initial spend and you have to pay the maintenance fee after that, right? To some extent, maybe for 1 year, 2 year, 3 year, 4 year. And normally they have a different life among themselves, right? So some server you can use for 3 years, some you can use for 5 years, some you can use for 10 years, some machinery, some genset or some other equipments where you have initial spend and then you have a regular maintenance expense at the end of every year, which you have to pay. And normally there is a life. Let's say there are two different choices that you have and they have different lives. How will you choose among themselves? So the one way to choose is to split your analysis in two parts. One is you calculate the NPV first. So in this case, let's say the NPV is calculated for project A minus 10, minus 1, minus 1, minus 1 because the life is 3 years. And the option B is you spend $7 million now, or $7,000 now, and after that $2,000 each year, right? Or for 2 years only, because this is only for 2 years. So you will calculate the NPV, which is means you will be spending over a 3 year, you will spend 12, and over the 2 year you will spend $10,000. If you just follow only the present value, you are likely to choose project B because it has a lower present value, right? But because the life is also different, it's only 2 years, and the project A is 3 years, take a look at the annualized cost. So this, we calculate the annualized cost of this $12,000 over a period of 3 years. So then now we will calculate the annuity. So we have a present value already, 12.49. We have a rate at 10%, and then so we will need to calculate the payment, the equal installment of the annuity. So if you use that, you will get a cost of 5,000 in 3 years, and for project B you get 6,000. So means even though the NPV, the present value of all the payments on the future on option A is higher, but if you spread them out over their life, it's going to be 5,000 only, so it's lesser. So you should choose the option A. Now there is another introduction to the option into this option C, where you will have a cash flow of this -14, -1.2, -1.2, -1.2, and -1.2. So what I want you to do now is calculate the net present value at 10%, and then calculate the equivalent 4-year annuity at the same present value. To calculate the easy way of NPV, you can use the formula of NPV. So you just plus the first cash flow plus the NPV, right? And then you just give them the rate, what is 10%, and then you just select the values. So 1, 2, comma, all the values are selected individually, and then you calculate. So this is the net present value of all the cash flows, minus 17.80, right? So if that is the case, so we calculate a net present value. Now we need to calculate the 4-year annuity of the same present value. So this present value, we will calculate the PMT. So it's gonna be 5.62. So when is 5.62? The original is A is 5.02, B is 6.03, and the C is 5.62, right? So it means that the cost of C is still higher, annualized cost is still higher than the server A. So it means option A, it means we still choose the server A. So if let's say the replacement cost at the end of years is going to be different because the price may increase or price may decrease, or there may be the other consideration that there may be different models of the machines that may become available at that point of time. So those are the additional considerations when you are using this method of equivalent annual annuity. Okay, and then sometimes you have limited projects, like limited money, limited resources, limited manpower. If you have to allocate based on that to remove the limitation on the NPV of different size, different scale, we use something called net profitability index. So which is NPV divided by the resource consumed, whether it's money or whatever is the limiting factor. So if let's say the money is limiting factor, then you will say NPV divided by the money itself, money invested into the project. So you will get the profitability index. Or if the limiting factor is, let's say, the resources, we're going to look at one example to show that. So then in that case, we will calculate a profitability index for each option, and then we choose wherever we can maximize our resources. So in this example, there are possible projects for $200 million projects. There is a $200 million project. We have initial investment of all two choices. One is 200 million, one is 120, one is 80, and we have an NPV of 175 and 70. So what we will do is we will first calculate the profitability index. So in this case, we have calculated a profitability index of project A at 0.5, 0.6, and 0.8. So the first step what we will do is we will sort them in the descending order. So we will select the one which is highest NPV, so project A, project C first, and then project B. Incidentally, in this example, it's equal to $200 million, and the third project again anyway is going to be, so we will be able to get an NPV of 75 plus 70, which is 145 million, compared to 100 million if we take only the $100 million this project, based on the simple NPV rule. Because the NPV is highest here, we are going to accept the B and C, so that we can maximize our investment, right? We will get $145 million. So here we have a problem that this company is a networking company. They are making a new project. So the expected NPV of project is 17 million, and it will require 50 people, right? It has 190 engineers available, but is unable to hire additional engineers in the short term. So it must be completed within the project. So now here is the different projects that they have, right? They have project A until F and the router project. The requiring of engineering is 50, 47, 44, 50, and all those kind of things. Now you have only 190 peoples, right? 190 engineers. So you are required to select which project you will choose. So how will you do that? So first we will calculate the profitability index based on engineering headcount. So NPV divided by the engineering headcount. So that will come to like this, and we will sort them into the projects. So 0.4, 0.4, 0.35, 0.35, 0.35, and all those. And then we will see what is the accumulative headcount which is required, right? So 47 plus 32, 79 plus 58, 130, 137 plus 50 on this project, 187. So since we have only 190 peoples, we will not be able to accept the project C, D, and B, which is giving us 14 million, 11 million, and 8 million. Project C is more than the project F, 14 million compared to 12 million. But because the profitability per head count is higher in project F, we will accept that, right? The only shortcoming of the profitability index is that it doesn't have an exact answer, because there are some resources which are not utilized, right? Like in this example, we saw the 3 engineers are extra. So what you are going to do with these 3 engineers? This method is not going to give that answer, right? And is often beneficial to focus increasing the binding resource context. So you can always increase the resources. And if there is a multiple resource constraint, then also is not useful, because it focus on only one constraint. If let's say there is a both constraint, the money also and the resources, then again it's gonna be difficult to make the decision. So you have to use more permutation and combinations to calculate the best possible outcome, but the profitability index can still be worthwhile to do it. These are the decisions. So formalizing the NPV, the rule is to take the project if the NPV is positive. It's simple to use. The only thing is it's a over relying estimate on the discount rate, which is an assumption. So that is the only challenge with it. The IRR is where you have an NPV equal to 0. IRR is more than your cost of capital, you accept, otherwise you reject. Advantage is that it's related to the NPV rule, and normally you have the same result. And the disadvantage is it's difficult to compute, and sometimes there are multiple IRR, especially when you have multiple cash outflows. And if the inflows is coming before outflows, then also it can be confusing. And it's difficult to choose between the 2 different projects because of the size. And then the payback again is the last, which is the simple rule is that we want to recover our investment in a few years. Simple to compute, but the disadvantage is that it does not really calculate the cash flows after, and does not take care of the time value of money, and is not scientific method. So that is the 3 method that we have discussed. And the last is the profitability index. It use NPV method as a basis and allow the projects to be ranked from top to bottom. The only disadvantage is that if there are more than one constraint, it will not work. It will be giving you confusing results. So that's and it may leave certain resources unutilized. And that's the shortcoming of this profitability index, right? So that was the decision making rules in IRR, simpler ones. So now we're gonna cover up a very theoretical aspect of how we do the capital budgeting. Why we want to do this chapter is because you have seen the NPV project, and normally there is a involvement of projections, right? You are going to project regular expenses and regular income, and also select the cash outflow, and there are other consideration on related with the tax and related with the depreciation to calculate the cash outflows, cash inflows. So that's why we need to understand the those concepts here. So what we will be learning is the process of doing it, and how we forecast the incremental earnings, how do we forecast the free cash flows, and also the analyzing of the project. In the capital budgeting process, normally you have to define a capital budget. There is an initial outlay, there is initial expense. Normally it's a project equipment or the initial development cost or increase in the working capital or things. And then there is an ongoing cash flow. So ongoing cash flows comes from extra revenue, extra income, minus the taxes and minus the change in working capital based on the future years, right? And then usually there is a terminal cash flow. So at the end of the project there is a sale of equipment, you that is also you may have to pay the taxes. There is normally a shutdown cost, there may be a clearing cost, the site clearing cost, and also the at the end of the day you will sell all of your inventory, and then that also you may receive a cash flow, right? You may have to pay the employee benefits at the end of the project, you may have to pay the retirement benefits. So those are all the terminal cash flows. So whatever you have to spend in order to end the project, that will be called terminal cash flows, either is inflow or outflow, whatever it is. Then you have ongoing cost. So whenever you are doing a project analysis, you will always be looking at only the incremental revenues and incremental cost, not the entire cost. Because let's say you buy a new equipment, right? So what we will do is we will want to know what is the impact over this expense on the revenues. Are we going to increase anything, or we are going to reduce any cost, right? Then only there will be a cash inflows. And then we also need to see the impact on the taxes, because whatever you are going to earn, you need to pay extra to the government also, right? So you have to calculate the taxes on the additional income or additional expenses, the tax impact, and then you have to adjust that amount also in the cash flow. And the lastly is the increment in the net working capital. So in the past we have learned what is the net working capital already. So whatever is the change in the inventory, is the inventory going to increase? Is my account payable going to increase? Is my account receivable going to increase? So that is the change in the cash flow on a regular basis that we also include in the cash outflow. So whenever you are calculating the cash, for calculating the NPV, whenever you are calculating the cash inflow and outflow, you cannot take just only the profit and loss statement and say, okay, I make this profit and I use this for my calculating the NPVs. That's not so easy. It's not that easy. You need to calculate only the free cash flows. So in the free cash flows, normally you also have to remove if there is any increased requirement of the maintenance cost, right? Or reinvestment cost, as you are saying, there may be some re-capex cost in the future. So you have to remove those costs from the future cash inflows. You can calculate the correct NPV in your project. So that's the typical outlay. So when you are forecasting the incremental cash flow, normally you have to differentiate between what is an operating expense and what is a capital expenditure. So capital expenditure usually are one-time expense, and operating expense are something which is recurring in the nature and it's not of the future use, right? So for example, recurring repairs, your payroll, your cost of goods sold, those are your operating expense. And you have capital expenditure, which is your initial one-time cost, your setup cost, your development cost, and also the future overhauling, the re-capex, right? As you were saying. So those are the two separate things, and you have to separate them out in your cash flow so that you know what is recurring and what is non-recurring. Because recurring expenses may increase at a variable rate, while the capital expenditure will be on extraordinary nature. So you have to separate them from the operating expenses. So that's how you will estimate the incremental cash flows. In order to gauge also the incremental operations, incremental earnings, and the operating expenses will hit your cash flows, right? P&L immediately in all the periods, while the capital expenditure will hit the cash flow only once, and then there will be a depreciation charge over the next few years. And for that you will have a tax impact, right? Because the tax payment will be reduced over the future periods. So that is the impact of the capital expenditure. So capital expenditure, when you are putting into the sheet, you will always have a depreciation part. What I wanted to say is that even if the net profit is negative, it doesn't mean that the project is not viable, right? The project can be viable because you are taking the free cash flows. So free cash flow will come from adding the depreciation back to the organization. So let's say the initial investment is not 30,000, is only 30,000, right? So in that case, your depreciation in 5 years is only 6,000 each year. So now in some years you are positive, some years you are negative, right? And overall is still a positive of $2,000 in overall, but NPV may be negative again. So, and maybe the project has a higher life. So you can be different scenario, but the point is to explain the concept of how we calculate the cash flows. So this is how we calculate the cash flows, how we encounter the cash flow between the operating expenses and the capital expenditure, right? So we calculate the depreciation. So there can be different methods of calculating depreciation also. There may be a straight line method where you say, okay, the total investment divided by the life, simple, finish, everything done. So this is the one example of operating simple way of calculating the depreciation. How we forecast the incremental earnings, right? So there are certain things that I have written down here, how we calculate the forecast earnings. So you need to give the some factors of estimating the project. Now this is a generalized way of explaining doing the forecast. It depends on the project by project. Usually a new project has a lower sales initially, and the average selling price of the project and its cost will generally change over a period of time. So once you have done in the year one, your sales may be lower, your price may be lower, but in the future you may be able to charge a higher price, and your variable cost may also change in the future. So you cannot just in the, like in this example, we just assume $10,000 for the entire 6 year, but it is not the reality, right? So there may be certain assumptions. Let's say I may be able to increase my price in 1 year, 2 year by 2%, 3% or 5%. So you need to have a better calculation than this, saying that how many products I will sell in the year 1, year 2, year 3, year 4, year 5, and what would be the price I charge. So same like Umar is saying that his price is increasing by CPI. So there is normally the price, you cannot just keep the same price for whole 6 years. You may have to adjust it by at least an inflation rate, or even if and sometimes price can even go lower, because if let's say you have a competition, the price war, then you may have to reduce your price in order to maintain your volume. So you have to think it through and keep your assumptions very clear, so that in the future you can come back to them, and whenever whoever is reviewing the project can test your assumptions. You cannot do the gross assumption like this, like I did, 10,000, 10,000, 10,000. You need to have a detailed working, how you are going to estimate your revenue, how you are going to estimate your cost of sale, repairs. It need to be variable. You can show that your assumptions are realistic. Mostly the industries, because of the competition, profit margins over a period of time tend to increase, but since the volume is increasing and there are fixed costs which are remaining there, the profit margin can grow in the future if there's no other factor of the competition, right? With the growth in the quantity, growth in the volume, your profit margin can slowly increase in the future. But in the initial years, usually you cannot estimate a very high profit margin, because you have initial marketing cost, initial setup cost, initial high variable cost. You don't have the economies of scale. So if you want to make your project realistic, you need to factor all these things into account. So what the focus is also only on how the cash flow will change for the firm. So we need to calculate the incremental earnings, incremental revenues, incremental cost minus the depreciation, incremental tax, the firms may have let's say tax holiday, right? In that case you cannot consider the tax as a cash flow point because you are not paying the real tax, right? So, and sometimes you have the previous losses, already accumulated losses, where you can adjust your incomes of this project into the previous losses. So in that case again you don't have to consider the tax benefit because you are not paying anything. That's the way. So you have to look at the reality of the organization, what we are actually doing, right? Then you have to also consider the tax impact of your incremental cash outflow. As I said, you may have a marginal cost rate, so there is usually a tax rate applicable on that. But if you have the losses already in the past and you don't have to pay the tax in the future because of the past losses or tax holidays or investment holidays given by the government, then you don't have to consider the tax into the calculation. Otherwise you need to include the tax also, like here I am doing 40%. So in the some cases you will see minus, even though the profit is not there, you still can consider it because normally the governments allow the tax offset to next years or next 2 years, next 3 years. So that again you have to think, if you are carrying over the loss for more than 3 years, let's say in this example the expenses are, let's say, $5,000, just to give you an hypothetical example. In this case now the losses are continue to increase over a period of 5 years. So by the law of the land you cannot carry forward a loss for more than 3 years, right? So in this case you will not be able to offset the cash flow. If let's say in the first year we are able to get the income of, let's say, $20,000, so you will not be able to use up all the tax benefit that you have accumulated in the past while we are calculating the entire value. So you may need to think how much you will be able to gain, and in this month you are not getting the benefit, so you cannot take it here. You are going to get the benefit only in the future months, right? So you need to adjust your tax so that you can calculate the right present value. Sometimes the tax impact is also impacting the net present value to be either positive or negative, the tax alone, because tax is sometimes quite heavy, about 30 to 40% of the cash flows. So here is the example that you are going to do now. So suppose you are the manager of the router division in Cisco, and you are considering to develop a new wireless home networking appliance called HomeNet, and that will provide both the hardware and software to run the entire home from the internet connection. In addition to connecting the computers and smartphones, it will control the internet capabilities and everything else. Based on their market survey, the sales forecast is 50,000 units per year. Given the pace of technology, they have a run of 4 years only. They have an expected wholesale price of $260, right? The price of that price the Cisco will receive from the stores, and the actual production is going to be outsourced to include a packaging of $110 a unit. To establish product, to develop the product, they need to establish a new lab for testing purposes. Can you note down these numbers, because then I will change the screen. It's $50,000 per year, the units, 4 years life, $260 price, and $110 of cost. Then the other things is, so to rent the lab you have to spend nearly total of $7.5 million in the new equipments. The depreciation is straight line, 5 year over a 5 year period, 40% tax rate, and the lab will be operational at the end of year 1. At that time the HomeNet will be ready to ship. It expects to spend $2.8 million per year on rental cost of the lab space, as well as marketing and support for this product. Now you need to estimate the future earnings of the project. So if you summarize everything, so you have revenues of 13 million, additional cost of goods sold as 5.5, right? Your gross profit is 7.5. Then you have selling, general and administrative expenses at 2.8, including the rental. Depreciation was minus 1.5. So you get your EBIT at 3.2 million, and you calculate 40% tax on it, which is, so you get the incremental earnings of $1.9 million, right? But in order to calculate the cash flow, now you need to put back the depreciation and also factor in the initial cost, which was how much? The initial cost was, I think, $7.5 million, right? So in that case, you just need to put $7.5 million in negative in year 0, right? And in this way, you will add 1.9 plus the depreciation, which is minus 1.5. So it will be 3.4 million, 3.4 million, 3.4 million, 3.4 million, and minus, plus of $2.4 million. Because assuming the $600,000 you can use in other tax liabilities of the company. So this is how you will calculate the incremental earnings. Usually now when you are forecasting the incremental earnings, you normally will create a pro forma statement and also taxes and negative IBT and interest expenses. So you normally have to create separate forecast. So when you want to determine the free cash flows, because earnings are not useful in calculating the NPV or IRR or anything, you need to convert the earnings into the free cash flows. So to do that, you will need to add the capital expenditure and depreciation to the net income that you are earning, right? So in that case, you will incremental gross profit minus depreciation minus EBIT, and then add back the depreciation. So incremental free cash flow will be 680,000, and also minus the initial investment as whatever you are taking. So if we go back to the initial investment that free cash flow that we did, if you add back the depreciation here and minus the capex, then your cash flows will come to 7.5 minus 7.5, 3.4, 3.4, 3.4, and $600,000. So that's how we calculate the incremental free cash flows. And now you can use this amount to calculate the NPV or IRR or whatever you want to do, right? So you need to know how we can get the figures which we have used in our previous slide. We have not considered one fact here, which is the change in the working capital, because there is a working capital involved. Whenever the HomeNet is going to use this, there may be some suppliers which they will not pay, there may be some stores who they will not pay. So there will be some initial working capital requirement, and at the end of year 5 they will also realize some of the capital investment. So there will be some additional free cash flow requirements. So that one also we can calculate by understanding the ratio analysis. If you remember, we calculated the inventory turnover ratios, AR holding days, AP holding days, cash holding days, right? Those days, those ratios will now come into your help to understand how much would be the inventory. So let's say your average inventory holding day is 30 days, right? So it means you will hold up 30 days worth of inventory in your stock, means you will not be able to sell it. You have to invest extra money, right? So if your cost of goods sold is $5 million, how much would be your inventory then? If let's say you are holding 30 days of inventory, 5.5 million divided by 360, right? That gives you average cost of daily sales, multiply by the 30 days. So that will give you the value of inventory that will be in your stock and unsold. So apart from $7.5 million, at the end of year 1, you will have to spend something on the initial investment of the capital. There will be cost of sales, right? The inventory means there will be some inventory holding less than 30 days, which comes to 5.5 divided by 365 multiply by 30 days. There may be some 30 days worth of revenues also which you are not able to collect, right? So in that case also you will do the same process. 13,000 divided by 365, you get the average daily sales, multiply by the 30. So you will not be able to get the 30 days worth of sales into your hands. So this way, this will be determining your initial working capital. And because the amount is not changing, so there will be no change in second year, third year, and fourth year. But at the end of 5th year, you will realize everything, because you will sell off your inventory, you will be able to collect your money, right? So at the end of the year 5, you will minus that amount again, or plus that amount. So there will be a cash inflow at the end of year 5, and there will be a cash outflow at the end of year 1. You understand the concept? So here is the example that I was showing you. So let's say 15% of the $13 million sale you are not able to receive, and there is an inventory on 15%, means about 2 months of sales. So you have a working capital requirement. So receivables 1.9 millions, payables also you have some. So there is a net working capital of 1.1, 1.1, 1.1, 1.1. But you will not use this in the free cash flow. You will use only the change from 0 to 1, 1 to 2, 2 to 3, 3 to 4, 4 to 5. So basically this 1.1 million you are not able to recover in year 1, correct? As we have assumed in the past that all the sales is recovered, all the payment is done. So our free cash flow is 3.4 million. Actually, in the year 1, we are not able to recover this much of sales. So this becomes an expense. So this becomes an expense for us in the year 1, right? In year 2, the amount does not change. So in year 2, there is no extra cash, extra expense or extra income. In year 3 also, year 4 also, nothing change. But in 5, you will be able to recover this 1.125 because you will get the payment, right, in year 5. So this way you will be adding that as an income in the year 5. So this is how it will be done. Cash flow in fact will be minus 1.125, and year 5 you will have plus 1.125. So in the net amount you will get this net cash flow. So you will minus the cash outflow in the year 1 and you will add the cash inflow in the year 5. So that is the impact of the net working capital change. If simply you have, let's say, the inventory also, right? Here we have not considered the inventory. Let's say there is an inventory, means there is some work in progress in the factory, correct? But because in this example we are not considering the factory because they have outsourced, so there will be working capital requirement in that factory only, not to the home net, because they have outsourced. But if they were producing by themselves, there would have been an inventory, right? There would have been some salary payable, some electricity payable. So you would have reduced your cash requirement or increase the cash requirement for that inventory or consumables or spare parts. So in the year 1 you would have that expense, correct? In year 2, 3, 4 you are not using them, or if there is a change you will factor in. If you have to increase based on the increase in the volume of the business, if you have to increase the inventory, if you have to increase the receivable, if you have to increase the consumables, you will factor that in. And when the project is finished, you are able to recover everything back. So that's why you will recognize them as an income in the year 5. So that is the free cash flows, how we calculate the free cash flow, taking into account the net working capital. So doing this project outflows, calculating the cash outflows is also something very important for calculating the project returns. So getting a right cash flow is important, right? Otherwise your decisions are going to be not correct. Formulas we have already learned, so we are not going to spend more time on it, but now you can calculate the NPV on these cash flows. So now we have got used only the cash flow, so we are not doing any calculations here, but here is an example to do the cash flow and we can calculate the NPV. This is what we learned in the previous slide. In this part we are just elaborating on how we get the numbers, right? How we get 7.5, how we get 2.2, how we get 3.4, and how we get 1.7. So this is how we get these cash inflow or outflow numbers. So that was another important aspect to share. But you also have to consider the opportunity cost, alternative use of your internal resources. You may be using some internal resources which you don't have to pay now, right? But they are the cost. Let's say you are using the company office and you are not paying any rental. So the project, if you outsource the project, if you do it from a different entity, you may have to rent an office, but now you're not renting the office. So whether you should take the opportunity cost into account or not, it depends on your assumptions. But ideally, if you are evaluating the projects on a standalone basis, you need to consider the opportunity cost into the project so that you can understand that this project is really beneficial or not. So for example, you are using the finance department from the existing company, right? You're not taking into account that you need to additionally hire a CFO or additionally hire a engineer or additionally hire a office. You can use the existing warehouse, you can use existing transportation methods. If you don't consider any cost of these internal resources into the project, you are actually making the project looks like very exciting, right? But if you consider the free price of these services that you are using from the internal resources, then you will be able to get the realistic value of your project. So it depends on how you want to evaluate your project, but ideally you should include the opportunity cost into the cash flows. Then you have the project other externalities, means this project may be killing your existing business, right? So that is called cannibalization. Means maybe if you want to launch a new product, it may hit the sales of existing product. Then in that case, you need to consider the loss of sales from the existing product as well. Your project evaluation will not be complete. You may have lost business due to the new activities. You may have some sunk cost, right? Maybe you have done research on a project. That research has no benefit now. If you are evaluating whether this project should be accepted or not, the sunk cost which you have already incurred in marketing research or in R&D for developing the project has nothing to do if you execute the project or not execute the project. So you should not include the sunk cost into your initial cash outflows. If you do that, then increase your cash outflow and make the project not worthwhile, right? Whenever you are evaluating the project in terms of cash outlay, you will only consider the additional ones, not the existing ones, because even if you don't do anything, that cost is already gone, right? You cannot do anything with it. So whenever you are making a decision at any point of time, you will need to check whether this cost you are including in the project evaluation can be avoided or cannot be avoided if I change my decision. If it cannot be avoided, you cannot put that into the project evaluation because that's called sunk cost. Unavoidable competitive effects means that if let's say you are not doing the project or you're doing the project, there may be some competition who may be challenging or who may be doing the similar thing, right, as you are doing. So whether you take the decision to carry out the project or not carry out the project, there may be certain cost which you cannot avoid. Basically, let's say you are considering launching a new project, your sales is dropping. Whether you take the project or you don't take the project, your competition are going to continue to hit your business. So you cannot take that into the account in when you are evaluating a new project, that my sales is going down. Yes, you launch a new product or you don't launch a new product, your sales will continue to go down, right? So it means that you cannot say that if I don't launch, my sales is going down. That's not the right decision to take. When you are considering that, you need to think about only the additional change or additional thing that is going to happen if you make or don't make a decision. So only the incremental effect, not what is already going there and what is not avoidable. Then the other impact on the incremental cash flow. Okay, so and then you have to adjust also the liquidation or salvage value of the project into the terminal cash flows, and you have to also have to consider the capital gain tax. So usually in most of the countries, when you sell the project, you gain any capital value or terminal value, you have to pay the project, you have to pay the capital gain tax.